Hello, I'm Brian Lucareli, Director of our Private Client Services Group and co-chair of our Family Offices team at Foley and Lardner. And today I'm here with Mark Mallery, Senior Counsel and a member of our Transactions Group. Welcome, Mark.
Thank you, Brian. Glad to be here.
And today we're going to discuss how to structure venture investments within a family office. So, Mark, before we start, maybe you could just share a little bit of your professional background with our audience, and then I'll jump right into it with some questions for you.
Gladly. Yeah, I'm a business lawyer here at Foley and Lardner. I practice in three primary areas: venture investments in venture-backed companies, particularly growth-oriented companies; corporate governance and working as outside counsel for those companies, kind of directing traffic for any general matters they may need assistance with; and doing M&A transactions for those companies on both the buy and sell side.
Perfect. So, well, why don't we jump right into it? I appreciate the background. So, first question. So, what are some of the factors that determine what investment structure you want to consider or use?
Yeah, as a general matter, our recommendation is to start with the discussion about the objectives of the investment, the details of the target company, and the circumstances of the potential investors in the potential financing. From there, we can structure the investment to optimize for economics, corporate governance, tax, and the other considerations that go into the investment structure. Generally, investments in early stage growth companies are in the form of simple agreements for future equity, also referred to as SAFEs, convertible promissory notes, and purchases of preferred stock, also referred to as equity financings.
Got it. So how do investors decide between like convertible securities and equity financing?
Yeah, financings via convertible instruments, so your safes and convertible notes, tend to be relatively quick. They're lighter on documentation. They tend to be lower cost overall. And so they're often used in circumstances for bridge rounds where a company is maybe seeking some financing now, but may need to raise more or larger amounts in somewhere in the range of 6 to 18 months. These kind of get them there without having to go through the full process of negotiating corporate governance rights and pegging a valuation for the company. Whereas with preferred stock financings, you tend to have much more complexity. There's more negotiated terms and a broader set of rights associated. So, for example, with safes, they tend to be used directly off the shelf. There's really only a couple basic terms such as valuation cap or discount that are negotiated, and they're a very quick process that get money in the door. Similar with convertible promissory notes, they work like safes, they're convertible into equity, but you have the added benefit of getting a debt position, which puts you in a senior position on the liquidation stack, accruing interest on the amount that's invested, but you still have the right to convert into equity in the future. And so you can kind of get money in now, but not have to go through some of the longer form negotiations.
Great.
Whereas sorry, go ahead.
No, so that's a great segue into the kind of the next question. And so how does that target company entity form impact the potential investment structures?
Yes, we typically see a lot of C corporations, LLCs, and sometimes some S corps. Most of venture style investments occur in C corps for a couple of reasons. Most venture investors have limited partners that can only invest in C corps. They can't invest in partnerships, and many LLCs are taxed as partnerships. Also, it's just what they're accustomed to. We see the most C corps, and there can be some real tax advantages to investing in C corps, especially if they are qualified small businesses. So most funds are looking for C corps, though we also do a lot of investments in LLCs, which structure is typically more flexible. You can have all the same rights associated with investing in a C corp, or you can deviate, though there does also tend to be some more complexity from a tax perspective because it's a pass-through entity, a tax as a partnership, typically.
So, and this next question could be a topic all unto itself, but are there significant tax considerations in the various entity structures?
Absolutely. One of the basic tax considerations is optimizing your investment to get long-term capital gains tax treatment on a sale or disposition of your shares when you ultimately have a liquidity event such as the sale of the company. But many investors are looking for additional tax benefits such as qualified small business stock treatment, where you can get up to $10 million of proceeds tax-free, or 10x your basis, which is 10x your original investment amount, tax-free on a disposition of those shares. So that is a very significant motivating factor for why a lot of these investments occur, why the investments occur in C corporations, and why investors can do very well in some of these growth companies by investing in a qualified small business.
Are there other type considerations with these, or is that kind of it?
Those tend to be the primary drivers, though of course there can be numerous others. In connection with transactions, you can do founder tax planning with trust and estates teams. You can do, various structures of investments that can optimize for whatever your investment objectives are. So that's why we typically start with the conversation, see what you're trying to achieve, both from an economic standpoint and from a control standpoint in terms of your involvement in the business going forward. Are you going to have an individual on the board? What are some of the preferred stock protections that you're going to look for in investment documents? And those are things that are in some ways standardized, but we see a lot of variation and bespoke versions of as well.
Got it. So last question here, and then we'll kind of wrap it up. So what are some of the rights associated with equity financing?
Yeah, so I touched on some of those, but typically an investor in an equity financing will receive some basic protections. Oftentimes they'll receive a right to designate a member of the board. They'll receive a liquidation preference, which is the right to get their money back first in a downside scenario. They'll receive minority stockholder approval rights, such as the right to approve a sale of the company, the right to approve a future equity financing. And these rights are often pooled among all the investors in a round, as well as other rights that are fairly common, such as pro rata rights to participate in future rounds of financing, information rights, registration rights, rights of first refusal on potential transfers by key holders, etc. So there's a slew of rights that are included in standard form documents called NVCA documents, and that's usually the starting point for an equity financing.
Got it. So, Mark, I want to thank you very much for your insights today. I also want to thank all of you for watching our presentation. For more information, please visit us at foley.com under Family Offices. Thank you.
Thank you, Brian.